Hello and welcome everybody. This is Dr. Richard Smith with Cycles TV, and today I have a very special episode with a man who needs no introduction to our audience, Mr. Bob Prechter. And Bob and I are going to talk about what is going on with gold today, a question that is on everybody's mind. So Bob, thank you so much for joining us today and for doing this very special interview at a very special time in history, and probably in the history of gold too, I bet.
Ricardo, it's good to see you. Yes, it could be actually very well timed for gold, to talk about gold. So we'll see.
I can't wait to see what you're looking at and what you're thinking about, and in general, talk a little bit about waves and cycles while we're at it. I'm sure I'll have some questions. Are you okay if I ask questions in the midst of your presentation, or do you rather kind of give your presentation and talk at the end?
It's usually smoother to give the whole thing.
Okay.
Only because sometimes questions get answered like with the next slide.
Sure. Very
Things
good.
like
All right.
that.
Well,
But it's up to you. I mean, you're welcome to interrupt.
I'll do my best to
If you
bite my
like.
tongue and
Well, you
only
know,
interrupt if I see something compelling that I really need to bring up.
yeah,
And
yeah.
if for our audience, I know a lot of people are familiar with your work, but even as you're going, if you wouldn't mind just kind of making sure that everybody understands the basics of what Elliott Wave analysis is. And always love little vignettes and anecdotes from all of your decades of experience in this unique field. So,
Well, we might have an anecdote or two. We'll see.
All right. Well, the floor is yours, Bob, and looking forward to it. Thank you.
All right. So today we're going to talk about the history and outlook for gold. We're going to spend a little bit of time on history so people can kind of understand the work that we do. This first slide, if you look over on the left, you'll see a quote from a bulletin that I sent out on September 23rd, 1980. And we wrote at the time, gold has now hit its minimum target of $710 per ounce London fixing. Yesterday's action in gold stocks smacked of a near-term blow-off, and the wave count for gold shows a completed 5, that means 5 waves, for wave C. Now, I rushed that one-pager out on the 23rd, which is about the time I thought gold was topping out, and 10 days later, the regular issue of the Elliott Wave Theorist went out, and now that's what we're going to see on the right. On October 3rd, I showed the picture that I was looking at when wave C, wave 5 of C over on the upper right was topping. And as you can see, if you're an Elliott Wave aficionado, these are very clear 5-wave structures to complete a 3-wave rally. So you've got a 1, 2, 3, 4, 5 with a triangle in the 4th position up to wave A. Triangles are always in the 4th wave position. 5 waves always means it's going in the direction of the one larger trend, and that is the case here. Counter trend moves are 3 steps labeled ABC, and you can see the ABC there leading down to a B wave, and then 5 waves in the direction of the larger trend to complete wave C. Now, the whole thing was a counter trend rally because if you'll recall, gold topped in January of 1980. But this was the time when I got really aggressive, and I said, this looks like a peak, not only for gold, but for gold stocks. If you recall, from that point on, gold went down for basically 20 years. Gold stocks have never recovered to the heights of that time. In fact, as of yesterday, October 17th, gold is 5 times higher than it was at the 1980 top of $850 an ounce. And the XAU, which is a gold stock index, is still below its 1980 top. And I've long been an advocate of owning bullion over the mining shares. And I think that's been the way to go. And I still think it's the way to go. So that was one juncture. Here's another one that we all know pretty well because we lived through it recently, which is the major top of 2011, September 2011. Now, this chart was put together by Steve Hochberg and Pete Kendall. Those are my colleagues who write the monthly Elliott Wave Financial Forecast. See, I do the theorist once a month, and they do the forecast, and so we alternate every 2 weeks. Somebody gets something from us. And so this showed the Elliott Wave picture again, 5 waves up, right? Because it's in the direction of the one major trend. And even within the 5th wave, we had 5 waves up. Gold topped a few days later, I think just above $1,900 an ounce. So we're not afraid to call tops when we see them. Now, this wasn't exactly at a peak, but it was at a rebound peak. And I'm kind of proud of this one. You asked for anecdotes. I think this is a pretty good one. If you look at the chart on the left, so I published this in December 2012. And if you look at the notes on there, you'll see on the 13th of September 2012, the Fed announced and began a $40 billion a month purchase program for mortgages. And then a couple months later, on December the 12th, Bernanke announced, okay, we're going to more than double this, and we're going to start buying $50 billion worth of bonds every month. Now, if you remember the commentary from people interested in gold back then, they said, okay, this is it. They're going to the moon. Bernanke's going to cause inflation. And if you look at my headline, it was a little bit cheeky, but I said the biggest inflationary Fed commitment in history provides another selling opportunity in the metals. All right. So why did I say that?
Please. Because,
Richard, as you know, fundamentals and outside influences in the Fed aren't making the markets go up and down. In fact, they're snowballs that get thrown up in the air so people can get hit with a line drive in the face. And that's what the market will do to you every time. So it's cycles or waves that are in charge. And the waves were very clear. And the psychology, of course, was clear as well. People were just so bullish at the time. We said, there's no way that they're going to go up any further. So what happened afterwards? Take a look at the right. Gold went down for another 3 whole years, all the way down into December 2015. So those are the kinds of things we look at. Well, what happened at the bottom in 2015? People were again bearish. They loved him when Bernanke started his program, and then he continued the program through 2014, and he stopped it. It was, there's no reason to be bullish on gold anymore. He stopped his program. But here was a chart that we published at the time, December 4th, 2015. Now, if you're an Elliott Wave person, you'd be excited by this chart. There's a beautiful triangle for intermediate wave 4. That's the one in parentheses, a 5-wave sideways structure, and then something called a diagonal, 5 waves overlapping into a low. And we were so patient all the way down. We said very little until this very time. And as you can see, the headline is Sharp Rally Imminent. I think that was like 2 days before the low, somewhere around 1,050 range. Now, I'd love to say that was a perfect call, but there's a flaw. If you'll see, there's a circle A down at the bottom. What we thought that was the first leg of a bear market. There would be a rally and one more leg down before gold goes up. And that was not correct, but we still called the bottom, and we were looking for a pretty good rally, a sharp rally, and we did get it. Now, this kind of brings you up to date. If you look down at the bottom of the chart, 2015, right? That's where we said sharp rally. And in 2016, we got a sharp rally, and it went sideways for a while and continued higher into 2019. And around then, we were saying, okay, that's enough for a recovery rally. But in 2020, gold sort of took off and made a new high. And we said, okay, something else is going on. It's back to the drawing board. What are we going to do here? Well, after 12 years of net sideways action, it was October 4th, 2023, right? We got really excited. And this is Steve on our short-term update. He wrote, gold steep decline hit 1815 yesterday, October 3rd, meeting the lower line of the zigzag channel formed by wave 2. Now, that's a little bit of jargon, but if you look at the 1 and the 2, you see the decline in 2. If you put that in between 2 parallel lines, right at the bottom of 2, it had hit the lower line.
Okay.
And then he says, if gold's larger trend is bullish, that should be just about it for the sell-off from the May 4th high. And then he added the DSI indicator for gold, that's the daily sentiment indicator, was at 11 last night after registering 4 days in a row of 8. Well, what did that mean? It meant 90% plus of traders were bearish on gold. And that's the kind of juncture we like. And you can see that even though it's $1,800, quite a bit above where it was in 2015, people hated it. They were shorting it. They were really negative. We said, no, man, we might have missed some of the move, but we're not going to miss the rest of it.
Mm-hmm.
So we got really bullish. That was almost exactly 2 years ago. A lot's happened in 2 years, right?
Oof, a lot.
And here it is. That's what's happened since.
Mm.
So I think the question and why we're here today is, what do we think is going on now? Well, I can count 5 waves up from 2015, as you can see labeled here. And in the 5th wave, which is an extension, typically commodities extend in the 5th wave. In the stock market, usually the middle wave is very long and strong, but in commodities, it's usually the last up wave, the 5th wave. And even within there, it's a nice 1, 2, 3, 4, 5. So I think at least temporarily, gold has topped out for a while. But if you look at the bottom left of the chart, you see that high in 2011 and the previous high in that we talked about in 1980. Those are part of larger structures. So
Mm-hmm.
I don't think this is the final high, never to be seen again, but it should be a high temporarily.
Mm-hmm.
Now here's a chart that Steve published last night. He's got a little bit different labeling than I do. He's got an intermediate 3 topping out, but we both are expecting a period of correction that should last quite a while and probably be pretty deep.
Mm-hmm.
But the reason I showed this chart as well is look at the bottom graph, the red line.
Mm-hmm.
This is Market Vane's bullish consensus.
Mm-hmm.
And as of yesterday,
Yeah.
we had a reading of 95. That's 95% of traders bullish. It was the highest level we'd ever seen. There was one equal way back when, I think it was probably in 2011. But in 37 years of data history, that was the highest, or that is, I should say, because that is the current reading.
Mm-hmm.
So look
Wow.
at the bottom of the red line back in late 2022. Now, that was a really great time to buy gold, right? So is now
Yeah.
a great time to buy gold?
No.
Not according to this indicator, no. So to me, that's a pretty good, let's say, support for our wave count.
Mm-hmm.
All right. So let's talk about something that so many people, like everyday people you run into, for some reason, they get more excited about silver than gold. I don't know why. Silver's underperformed.
Or a silver coin and not a gold coin.
I think that might be it, but it's sexy to people. I don't know why.
Mm-hmm.
People have been calling for $200 silver since I got into business. We've
Mm-hmm.
never seen it. In fact, silver's been the worst performing of any market or commodity in the world, and people still love it. But anyway, let's see
Wow.
what's going on over there. So 4 months ago, okay, this is on June 20th, 2025, I published this chart and I said, get ready for a major spike in silver. Why would I say that? Because if you remember the chart we just showed on gold, it was heading into a very strong 5th wave.
Mm-hmm.
And the 5th wave is when silver wakes up. It happened in 1980.
Mm-hmm.
And it happened in 2011, and you notice how quickly it reverses because
So
it's
those were 5th waves in gold that
yes.
strengthen or that. Mm-hmm. Interesting.
Well, those are the most speculative, maniacal waves, right? The final
Right,
move.
sure.
And so people
Yeah.
look around, I'll buy the poor man's gold, so they buy silver.
Right.
And it did materialize. It was in the 30s at the time, and of course got to the mid 50s. So we've had our spike. Theoretically, it could go even further to the moon if it wants. But
Mm-hmm.
the point is, we've had a pretty good spike in silver.
Yep.
But if you look at the low that occurred in 2020 on silver, way down there, I think it was around $10 or $11. It doesn't really look like we've had a 5-wave up move. It's possible that this is temporary and that we'll get a bear period and then there'll be another jump. We shall see. But for the moment, and I'm going to give you some more reasons why, I think silver has probably seen it for a while. Now this, I grabbed this morning. This is right out of Bloomberg. And it showed a really cool chart of borrowing costs for silver. Now, these are, people that promised silver sometimes can't deliver. So they have to go out and borrow it from somebody else. Somebody says, well, if I'm going to lend you my silver, I'm going to charge you something for it. And it's usually just, 1 or 2% annualized. But look what it did here in October 2025. It jumped all the way up to about 35% annualized. That's usury rates.
They were bringing back up the Hunt brothers and cornering the silver market.
That is right. So, when you look at this, you say, well, did that sound like a mania peak? Well, it looks like one.
Looks like an
It's
extreme not to be repeated.
unlikely to be repeated right away. But unfortunately, these indicators do not control the market. They simply report. And sometimes if the market's going to get even crazier, like we've seen, say, in the stock market, these indicators get higher and higher. But that's certainly significantly above where it was in September. That's for sure. And then here's something fascinating. People in India went crazy for silver in October to the point that in the stalls where they sell the stuff, people were getting $8 an ounce more than they were charging in London for silver. And this is a really great quote here from the article. Dealers in Mumbai's busiest gold bazaars began charging prices well above international benchmarks, while bidding wars broke out between wealthy buyers who cared more about availability than price. So what they were doing was they were grabbing their bundles of cash and going down there, slamming them on the table and saying, turn that into silver. I don't care what you charge me. And when does that happen? It doesn't even happen during the midway, or certainly doesn't happen at bottoms. It happens usually within a day or two of the top. You asked me for reminiscence about this. I was in New York City in January 1980, actually at a brokerage firm, sitting next to a trader, and the trader came back and he looked a little bit shaken. And I said, "What's going on?" He said, "Well, I just went down and grabbed a sandwich and went over to my friend's place. He has a coin shop." And he said, we're sitting there talking, and this guy rushes in, opens up a briefcase with $50,000 in cash. And he said, turn that into silver. And the coin shop owner said, I can do that. He said, but I'm going to have to call in for a price. And so the guy says, okay, fine, hurry up. So he calls in a price, and he says, I'm going to have to charge you $52.50 an ounce for this. He said, I don't care what you charge me. Turn that paper into silver.
Wow.
And he did. And if you remember, spot silver never went above $50 an ounce. I think a futures contract went to $52.50. So this guy was the only guy I had ever heard of that paid more than the cash price for silver. But that's what the people in India were doing a couple of days ago. Turn this into silver.
Interesting, Bob, that you've lived through, a couple of these peaks before.
Yeah. And you get the same story,
Does it feel the same to you as it did in 1980 and 2011?
I think it's a little less intense.
Yeah. Like the mania could go on.
Well, you not only had the Hunt brothers that you mentioned,
right.
But we hadn't had a gold mania before for, like a century or more, and maybe Civil War, something like that. But so it was new, and it was, it took over everybody's minds.
Right.
Today, there are more people maniacal over stocks than there are over gold and silver. So to me, it's small potatoes relative to 1980.
Are you thinking about the so-called debasement trade much, or you don't really pay attention to those?
Yeah, you'll have to define that one for me.
The idea that people are going back to hard money because fiat currency, particularly the US dollar, is no longer a trustworthy asset.
Right. And in December 2015, was anybody talking about that?
I think so.
I don't think so. That was at the bottom and nobody cared.
Okay.
So when they're buying, and they come up with every story in the book, and the dollar's going to zero, and it probably is eventually. But they call these reasons, but it's just rationalization. I'm bullish. It's going to go up. Let's see. Why can I be bullish? Okay, debasement. So they buy it. So yeah, I think these what would you call them? Stories or narratives, I think is a good word.
Yeah.
Always follow what's going on in the market. So
the moves come first and the narratives follow.
Absolutely. Because they're rationalizing what's already going on. Anyway, that's my view of things because I think markets are internally controlled. They're waves of psychology that make people behave the way they do, not for these outside reasons. So anyway, so much for that. I'm just showing some things that say, silver did have a spike, gold did have a spike. It's probably over for a while. So you want to change subject just a little bit?
Yeah, let's keep going. I'll save my questions for
All right.
after the charts are done.
This is one of my favorite charts. I've been keeping it for decades. And it's going to show the Dow priced in real money. And if you invert it, you see gold priced in stock shares. And this takes us all the way back to the founding of the United States. In this case, our low price was 1792, a little bit a couple of years afterwards. And you'll see a beautiful Elliott wave. Now, we mentioned earlier that waves move in five in the direction of a larger trend, and then ABC or three-step move counter trend. I think it's a very clear 5 waves up from the late 1700s up to 1965. That's called the orthodox top. That means the top where the 5th wave occurred, okay?
Okay.
So even though it made a higher high in 1999, I'm counting that as a B wave, part of a corrected process.
Okay.
So we had the A wave low in 1980. Then we had a higher high in 1999. I think that was a B wave. It held up there for a very brief time. Plunged into 2011. I think that's wave 1 of C. And then we rallied.
These bottoms there in 1980 and 2011 correspond to the highs in gold.
That's correct. And that's why these ratios hit their lows at that time. That's one of the reasons. Stocks were also kind of weak into 2011. Okay, and then we've got what I'm calling 2 of C. So we're going to go down and see 5 waves. So we've had 1 down, 2 up. It's kind of interesting because I put the 2 up there at the peak price. Now, these are year-end readings. And that year-end
2021, 2 there?
Yep.
Okay.
2021.
That's a 2 of C. So we're in the C wave down here. Or no. The C wave is, right. Is this the C wave up or down?
Down.
Down. Okay.
And wave 3 of C will be down. And as we talked about before, wave 3 should be very big move. Well, you and I spoke in 2021, and I had a tapestry of time elements that pointed to a major top in the stock market in 2021.
Was that 5
And I was very surprised after they went down a year, and into 2022, they took hold and went back up to a new high. Well, something happened in 2021 because at that year-end price, I think that was it for the stock market priced in gold. But anyway, those are year-end prices. We're going to zoom in now and look at a little bit of shorter term. I'm going to show you the details from 1999 to present, okay? So that'll be the wave 1 down and wave 2 up in a little more detail. All right, so there we are at the top left. The peak in the value.
1999. Okay.
99, yes. The peak value for stock market, at least the Dow Industrial Average here, was worth almost 45 ounces of gold. And then after a 12-year bear market in this measure, it was worth only 6 ounces of gold in August 2011, which is amazing. I mean, that was only 12 years later.
Wow.
And then stocks actually outperformed for 7 years into September 2018, when the Dow was worth 22 ounces of gold. Well, the bear market resumed at that time. So intra-year, the 2018 was the peak. If you use year-end prices, it was 2021, but that was the top. And then we've been in a bear market ever since in terms of in the stock market, in terms of gold. Now, what does that mean? It means if we had stayed on the gold standard and they didn't let the dollar float free and allow the Fed to create as many as they wanted, this is what the Dow would look like. It wouldn't look anything like we see today.
I saw the S&P terms in gold, back to 1999 just last week, and it was incredible. I didn't even realize that stocks priced in gold, are not even close to their 1999, 2000 peaks.
Not only that, if you remember the previous chart we just looked at, they're currently worth less than they were at the top day in 1929.
Yeah.
That's zero progress in almost 100 years.
Ah.
All right.
Oh dear.
Okay. So we're back to this one. Now you might look at this and say, okay, we're talking about a temporary high in gold. Does that
Right.
mean stocks are ready to outperform again? Is this line
Yes.
going to turn up?
That would
I
be
think
good to
that's
know.
a logical question. So we asked the question, and now I'm going to try to answer it. I'm not going to go into a lot of detail, but I'm going to give you one picture that will tell you why my answer to that question is no. Stocks are not going to outperform.
Mm-hmm.
Okay, this is a picture of the valuation of using two measures of the stock market. On the x-axis at the bottom, we have the S&P 500 dividend yield on an annual basis. And on the y-axis, we have the S&P Industrials price to book value ratio. And if you look at the box, you can see that from 1927 to 1987, that's a 60-year period, almost all of the 20th century. Valuations for the S&P were basically in a range between a dividend of 3% and 7%, and a book value of 1/2 to about 1.4.
Okay, so that's 60
1.3.
years of market history there, annually, all contained by those borders of the box.
Right. Now, you might ask, okay, that's up to 1987. What's happened since? Now, I'm going to show you an updated chart of the two indicators together and see if you can locate where the box is.
Yeah.
We call this the Pluto chart because we're at Pluto now. And just for this presentation, I decided to update it through the end of September 2025. If you look at the upper right, you'll see the bullet up there. So we're so far beyond what people used to consider a normal range of valuation. I mean, it's unprecedented.
Yeah.
Price to book is 7.4. Remember, it was as low as 1/2 and maybe 1.3.
Wow.
Dividend yield, which used to be 3%, was considered low. In fact, it was 2.9% at the top day in 1929. Now it's 1.17. Virtually no yield. You can get more yield out of a T-bill. It's ridiculous.
Mm-hmm.
So I don't think stocks are going to outperform gold at all. They're poised for a big disappointment for the longs at some point whenever the market makes up its mind to come back to reality. It's got a long way to go. Now think about this. Just to return to that normal range, the market would have to drop something like 90%. And that's if there's no change in dividends or book value. Yeah. And if the stock market started to fall, I think the economy would contract and that would affect those things as well. So the risk in the stock market is way more than it is in gold.
Mm-hmm.
So anyway, that's my view. And just as some people always ask, well, because these are so hot and people love them now, should you invest in cryptocurrencies? And there's a big gold versus cryptocurrency thing going on. Cryptocurrency people have been beating the pants off the gold people for a long time, but I think that's changing.
Not lately.
Not lately. First of all, the total crypto market cap tops $4 trillion. Now, when cryptos began, it was 2009. That was when Bitcoin came to the fore.
Yeah,
was invented, really.
Yep.
Do you know how many cryptocurrencies there are now? I remember I was talking to my son Elliott. He's a big fan of cryptocurrency. Mm-hmm. He came on early, and when there were 12 of them, we thought it's getting ridiculous.
Right.
Now there are 1 million of them. They serve no purpose.
Oh my goodness.
They're just names for people to speculate with. Anyway, $4 trillion crypto market.
I remember a young guy saying, one day I think we'll all just be trading memes.
Trading them, yeah, trading memes.
And that does kind of feel like what we're doing. But it also sort of sheds light on, well, what are we doing with equities? When the dividend's at 1.17%, you're not trading the dividend. You
No.
are trading the stories.
Yeah, well, actually, I think this is a secret. We're always trading memes.
Yeah.
These things don't mean anything to anybody. Um, they're always just, Kodak, or uh, I don't know, whatever the hot stocks were back then. It's a name,
Yep.
U.S. Steel, all
Yep.
excited. And then 40 years later, it's not worth anything.
Right.
It's just a name.
Yep.
Okay, so what do I think of cryptos? Well, here is Bitcoin. Not many people know this, but Bitcoin started at a penny. So when it got to $100,000 a coin, that was a 10 million times multiple.
Wow.
Um,
And we still don't know who Satoshi Nakamoto is.
no, but he was brilliant. I bet he didn't even keep enough of the coins, but if he did, he could own the world. For the moment, I think it was Jesse Livermore who said, the public's profits has big profits on paper where they will remain. The public never cashes out. They don't keep their money. But there's more of interest on this page. Richard, take a look at the bottom left.
Bottom left, okay. 2009, 1 penny.
No, the
Oh,
arrow and the
Bitcoin
text.
recommended at 6 cents.
Yeah. Now, I don't take credit for that because my son, Elliott Prechter, wrote the article. He's a computer geek and he was excited about Bitcoin. And when he told me about it, I was excited about Bitcoin because I thought this is going to be an amazing thing. It could take over the world because imagine a currency that was not run by the government and was not inflatable. In fact, by its very nature, once they've created all the coins, it can only deflate.
Right.
So if you saved your money in Bitcoin, you could retire. If you save your money in dollars, you can't retire because they keep getting eaten up and ruined. And people keep saying prices are going up, but of course they're not. Prices are actually down a lot if you measure them in gold. It's the dollar that keeps getting worth less and less. Anyway, September 17, 2010 was a beautiful time. It was 6 cents. And we published a 2-page discussion of what Bitcoin was and why it was such a good idea. Well, I tell you, when it got to about, 5,000, we thought this is insane. We had no clue it was going to go 20 times higher than that and make it to 100 plus.
Yep.
So if you look at the wave count on here.
You still think it's a great idea, Bob, or you're a skeptic now?
I think it was a great idea until they discovered that the blockchain doesn't work.
Tell me more.
You can't transact in the stuff. It's too complicated. It takes too much power and too much time. And that's why people don't have Bitcoin wallets and spending them like they do dollars. It takes too much processing. And I think the creator didn't take that into account. He had a great idea, but it really doesn't work. So there are a couple possibilities. One is that Bitcoin itself redesigns in a way that the blockchain is no longer a problem. If that were to happen, it could take over as the world's currency, which was the promise at the beginning.
I mean, that is what Ethereum did, right?
Yes.
So Ethereum changed from proof of work to proof of stake.
Yeah. That makes it more interesting from a technological point of view.
Yeah.
But let's look at it from a psychological point of view for a moment. If you look at the waves on here, I think we have 1, 2, 3, and that's an extended third, the classic move in the middle. 4, and I think it's topping out in wave 5. So no matter what the future is for Bitcoin or Ethereum or any other altcoin, I think they're heading into a bear market that's going to be, huge. After 10 million times multiple, it's going to come down a long way. So the stock market is insanely overvalued. I think cryptocurrencies are insanely overvalued. Gold and silver are not. They're probably peaking in a mania, but they're under-owned. I think it was back in the late 60s and into the late 70s, people would have as much as, money managers would have 3 to 5% of their money in gold.
Mm-hmm.
Now it's something like 0.3%.
Mm-hmm.
So they haven't gone as crazy in the metals as they have gone in these things.
Mm-hmm.
If any of their people watching here would like to read what we posted in September 2010 about Bitcoin when it was 6 cents, just go to elliottwave.com, our landing page, and scroll down to the bottom, and you'll see a bunch of buttons, the red buttons. Just press the cryptocurrency button. It'll take you to a page where we try to sell you a service, but there's also a link there where you can read our 2-page piece. Now, this is what we try to do, right, Richard? Cycles are all about, can you identify a top or a bottom? And, this is better than figuring out Xerox before it took off because it went up so much. And these are the kind of things we're trying to do, be ahead of the crowd and do things other people don't think about. Anyway, at this point, I'm bearish. Elliott's bearish. We all think cryptocurrencies have had the biggest and most insane mania of anything ever.
So what I'm wondering, Bob, after listening to all this, and thank you again so much for putting this all together for us. It's a fantastic presentation. I'm just thinking of gold. I mean, basically what you're saying is everything's going down.
Well,
everything's looking, in looking toppy, right? Stocks and gold and Bitcoin all look toppy. So
short term.
Let's
suppose
when kind of everything's going down. Is something else going up? I mean, and the dollar's probably going down too in your thesis.
No.
If
stocks and debt and gold goes down, the dollar is going to go up. But let's not talk. Let's make sure we stay focused here. Do you remember the bull market in gold from 2001 to 2011? Do you remember what happened to gold in 2008?
You mean when we had the great financial crisis?
Yes.
I believe it took a pretty good beating.
Yes, it went down.
Yeah.
So I think it's a similar juncture. Stocks look ridiculous. They haven't turned down yet, or they might have, but we don't know it yet. We haven't seen any proof. But if we're going to have a bear market in these other things, it's going to be probably a deflationary episode like 2008. And that would put pressure on gold and maybe give us that wave 4 of either intermediate or primary degree and setting it up for the next move. So this brings me to the next, and I guess maybe the final question for our talk today.
That is my question.
Yeah. Stocks or cryptocurrencies, what is the best investment? Yeah. Well, I want to show you a chart that I published 15 years ago on the long-term picture for gold.
Okay.
Well, we won't know, we're doing our best here.
Sure.
When gold topped in 1980, it actually hit the upper line of a trend channel going back to 1968. It was a perfect touch. So I said, if that were to happen again on a larger scale, what would it look like? So I drew it out, and this is what I came up with. Now, this was back when gold was at $1,350. Okay. So it's tripled since then. So I decided, okay, let's update this chart and see where we are. So in June, 4 months ago, I updated it. And this is with gold at $33.80. It's up $1,000 an ounce since then. He said, look, if this is really going to happen, it's going to go up for a number of years, probably to the end of the decade. And I still think that is possible, if not I would say it's likely. So when we talk about a short-term top or an intermediate-term top, it's going to shake a lot of people out, get them out like it did in 2008. But I think it'll probably resume its bull market after that time. And for my last invitation, this is also on the homepage of elliottwave.com, right at the top. Don't worry about the advertising part. Just look at the arrow. If you want sort of a review of some of the history that we've had on calling gold and silver, just click on the gold and silver button there, and
Okay.
we'll send that to people if they're gold bugs and want to know how we've done on gold in the past. So, I mean, I think our timing here is pretty interesting from what just happened this week, or maybe even on Friday. Nobody's ever going to call things perfectly, but we were super bullish, 2 years ago, and not so much right now. And that about wraps it up.
Incredible. Thank you so much, Bob. I would affirm or also mention that we had a very, very strong cycles convergence on daily and weekly cycles, suggesting tops. But meanwhile, the momentum in gold is still going straight up, right?
Yes, but that happens in commodities.
Mm-hmm.
It happened in oil at the top in 08, it happened in the top in gold and silver in 1980. So yeah, that's normal for a commodity. You can't wait for divergences, really.
Yeah. You mentioned sentiment as another indicator that you seem to combine with your Elliott Wave analysis. Are there any other indicators that you use besides sentiment together with Elliott Waves?
Honestly, most of the time when I rely on other indicators, especially momentum indicators, they tend to get me in more trouble than they help.
Mm-hmm.
In the stock market, you always want to see divergences and non-confirmations, but you'll also see many of them that occur and then they just get taken out.
Mm-hmm.
But I
Yeah.
would say it's extremely reliable in the stock market to have non-confirmations. So momentum can be helpful there.
Mm-hmm.
Sentiment, I would have to say, has actually been harmful because I think stocks have been in a grand super cycle final move, which is a very large degree. The last time we had that was 1720 in the South Sea bubble in England. So it's been centuries since we've had anything this size. But if you go back to look at historical extremes in sentiment indicators, they've been taken out for 15, 20 years,
Mm-hmm.
and they just keep getting more extreme. And
Mm-hmm.
there are 3 or 4 bears out there who are citing these things, and we're definitely one of them.
Mm-hmm.
And there's including a PhD economist, one of the only guys who's bearish out there, and he keeps scratching his head and beating it against the wall, saying how much further can this go? It's stretched to the limit. So I mean, yeah, we look at those indicators, but if you ask me would I have done it in retrospect, I probably would say I just watch the waves
Mm-hmm.
because I think they tell the truth.
And waves, you talk about them as being psychological. So do you see them as some kind of internal structure in our human psyche that is then manifested collectively through our collective actions in markets?
I think human society ebbs and flows through sharing mood, which is social mood,
Mm-hmm.
and that it fluctuates in waves.
Mm-hmm.
You can look at nature and find fractals everywhere. If you
Mm-hmm.
look at a tree, it's a fractal. Plants are
Of course.
fractals. Our nervous system is a fractal. Our lung system is a fractal. The brain is a fractal in terms of its blood vessels and things like that. I think human society is changing its mood in a fractal form, and it's part of nature. There's
Mm-hmm.
nothing we can do about it. We are sort of programmed to participate in waves, not to recognize the turns. And that's why at bottoms in the market, people are bears, and at the top, they're bulls. It'll never stop because they're participating in these waves of social mood, and that's creating
Mm-hmm.
their opinions on the market.
And the 3-5 structure, is that um, just what you have observed over time, and that is why that 3-5 structure is there, or is there any other rationale for?
Yeah, it's the simplest form that allows trending and fluctuation. If you
Okay.
break it down and continue to multiply it, you get more and more fives and more threes of a larger degree or smaller degree.
Mm-hmm.
And it's the simplest expression.
Mm-hmm.
So if you wanted
Right.
to perceive change, that's how it would be structured. As to
Mhm.
why. I mean, we can never know the ultimate why,
Sure.
but it was in 1935 when R.N. Elliott decided to start studying the stock market charts.
Hmm.
And he was the one who in 1938 published his first book. And he said, I think there's a form to the stock market. And
Uh-huh.
it's 5 waves followed by 3 over and over again.
Yeah. I know that your son Elliot has been doing some computer analysis of Elliott waves. How are you feeling about that venture?
I'm really blown away. I've been actually working on a computerized version of Elliott Wave since 1986.
Hmm.
I hired a couple of guys from Lockheed Corporation who thought they could do it, and they did as good a job as one could do with the old technology.
Hmm.
But it wasn't until we scrapped that whole thing, and Elliot, who went to MIT, took computer science, and he worked for Microsoft for a while. He worked for a hedge fund for a while.
Hmm.
And when he left that, I said, well, I know a good job for you. And so he said, yeah, that could be interesting. He was a bit of a skeptic about the whole Elliott wave thing, but when he started studying it, he couldn't believe it. He said, this is happening over and over again. And he started creating the statistics of what we call iconic counts. Those are wave counts that
Hmm.
everybody agrees on in history and will never be changed.
Hmm.
So he's got the statistics rather
Hmm.
on how waves relate to each other. He's got the distributions, so
Hmm.
that helped him create the program. He's been working on this program for years, and finally, I would say hit its final form about a year ago. So we started offering it.
Hmm.
If you go to ewaves.com,
Yep. Ewaves.com. Hmm.
yep, you can discover what he's been doing,
Yeah.
and have have access to it yourself if you want. It's just an amazing thing. It counts better than most humans without the emotion, and it doesn't look at sentiment indicators.
Hmm. Yeah, I'm very interested. Lars and I had a great visit with Elliot last week. We really enjoyed having Elliot in New York too. That was fantastic. So I
Cool.
personally am very excited about the opportunity to potentially collaborate on this with them and maybe even bring cycles and waves together.
He said he really enjoyed talking with you and Lars, and thought you're very sharp and with it. And he doesn't say that often, so he's excited to work with you guys too.
And I loved that he, in New York, when he called, maybe this is the name of his company too, qualitative analytics.
Yes.
That whole idea of qualities versus quantities has always been something fascinating to me. And the fact that he calls his enterprise qualitative analytics was, really got my attention.
Well, the big rage for 30 years has been quant.
Right.
And from day one, I said quant can't work. People
Hmm.
would say, why not? I said, because the market doesn't run on absolute quantities. There are no number of days or weeks or months or years, and no X amount of price means anything. The
Hmm.
only thing that matters is relative uh, amounts, not absolute amounts.
Hmm.
So it's one wave relative to another in price or time. Those are the things that you can nail down and find consistency and things you can rely upon. But it doesn't matter, if they say, well, the last time the market went up 9 days in a row, X happened. Doesn't matter. It depends on where you are in the whole system, the wave system that matters. So quant can never find the right answer. I
Hmm.
don't care how much they throw it at
What
AI, for instance.
What do you think about back testing?
Well, there's nothing wrong with back testing, but if you tweak a model based on back testing, all you're going to do is make it optimal to the past.
Right.
And if you're using the wrong approaches, that's just going to get you in trouble. So, I mean, if you have a system and you want, what we did when he finished E-Waves, finished developing E-Waves, we started testing on all kinds of other markets, bond markets, foreign stock markets, commodities, and so forth, and found that it was basically working just as well no matter where you were looking. And that
Hmm.
proves that the basis of this is human psychology. It's not whether the market involved is in one country or another.
Hmm.
So it's not exactly back testing. It's more like we're testing to see if it worked with back data, but
Hmm.
we didn't use that to then, let's change X, Y, and Z because something else popped up.
Hmm. All right, one more question. The can you describe the kind of psychology of each of the 5 steps in a 5-step wave? Is there a psychological characteristic?
Well, I did that way back in 1978 when I wrote Elliott Wave Principle with A.J. Frost.
Mm-hmm.
And I think it still holds to this day. And it's kind of classic. The first wave off a low is a tentative buying. People are exhausted and they've sold out everything. So it's almost like gravity and going in reverse, bringing it up.
Mm-hmm.
People, the public and people who are not very sophisticated usually are selling into it like crazy because they think it's going to be a bear market rally. In wave two, on the downside, and by the way, you can invert all these characteristics when they're heading in the other direction, but we're going to talk about a bull market here.
Okay.
This is where people are usually as bearish as they were at the actual bottom. Remember that chart I showed where we got really bullish at around 1810 on gold?
Mm-hmm.
That was a wave too low, and it was up from about 1,050.
Mm-hmm.
But the bears were out in force.
Mm-hmm.
They said, no, we hate them, we hate them. That's a classic wave two situation. It means we're about to go straight up in wave three. And wave three is the middle portion where it's a freight train, usually in wave three, very strong. This is the stock market. The fundamentals start improving and people go, oh, I can see reasons why I should own them now. And then you get wave four. I call that the surprising disappointment. When everybody's on board at the top of wave three, wave four comes in and usually is a long sideways situation, which is very frustrating for a long period of time. Mm-hmm. And then the fifth wave, that's the speculative move. In commodities, it's usually the longest of the sequence. Mm-hmm. In the stock market, it's usually not the longer wave, and it usually starts to slow down. And if you're watching your momentum indicators, they're usually divergent. So that's it. And then ABC, on the downside, it's interesting. A is usually very volatile, can be violent. Mm-hmm. And yet people say it's a buying opportunity, it's a buying opportunity, it's a pullback. Even the crash of 29, they all thought it was a buying opportunity. And then you get the B wave up, and this is where people get really, really bullish. They think the old bull market has resumed. 2007 high was a B wave, for example. Mm-hmm. And then when that's finally over, C comes in, there's no place to hide. Every stock goes down until you finally hit bottom. So, yeah, they have their personalities.
Very good. Thank you. And actually, I did think of one more question, which is, what's this story about Shakespeare?
About 1998, I got interested in the Shakespeare authorship question, as it's called. Who really wrote Shakespeare? The standard story is absurd. They've got a guy from a pig farming hamlet whose parents and wife and brother and sister and kids were all illiterate. They signed with an X. So he is not a likely candidate for being the most brilliant writer of all time. Mm-hmm. So in 1920, a man with the unfortunate name of Thomas Looney, which allowed the Orthodox people to make fun of him because of his name, came out with a brilliant book. He said, look, let's suppose we don't know anything about this guy. Where do you start? How do you figure him out? So he read all the plays, and he said, well, there are several characteristics this guy had to have had. He listed all the characteristics, and then he said, now I'm going to go through all the personage of the Elizabethan age and figure out who's the most likely candidate. Mm. And one just exploded out of the mix, and wasn't very well known. He's becoming much better known. Mm-hmm. His name was Edward de Vere. He was the 17th Earl of Oxford. He was one of the most educated people ever to walk the face of the earth. At about 4 years old, he was sent to live with a tutor until he was 12. He was reading Greek and Latin and Hebrew and everything else as a kid. And this is where all of the plots came from Greek tragedies and the Latin plays and so forth. So anyway, he identified the right guy. And he was born in 1550, but Shakespeare didn't debut until 1593 with a poem called Venus and Adonis. And I thought to myself, he can't have started at age 43. He must have written some other things. And so I began to look into it. I spent 25 years reading every single play, virtually every poem, and every prose story written during the Elizabethan times, up to 1604 when Edward de Vere died, and a little bit after that.
Mm-hmm.
And I think I finally have delineated all the works that he wrote under other people's names. Shakespeare was not his only pseudonym.
Hmm.
And I had to read, of course, everybody else's works to be able to identify which were his.
Mm-hmm.
So I have a list of 350 writers who I believe are independent, and then a bunch of names that he simply wrote under.
Mm-hmm.
A lot of them were real people. He would just assign their name to a work. So that's why people think real people were all writing these great works, and it was really mostly one guy. So if you want to look at that, go to oxfordsvoices.com.
Oxfordvoices.com.
Oxford's plural,
Oxford.
no
Okay.
apostrophe, voices.com.
All right. Incredible stuff, Bob. Thank you again for putting it all together. And thank you for your decades of work on this very important subject and I really love it how you've taken it, not just to markets, but beyond markets, and worked for a real understanding of what the heck is going on, because it's difficult to make sense of things in our world today. And I appreciate your efforts to really try to make sense of things and find the truth. So thank you for that. And thank you again for sharing this all with us today.
And the same to you and the Foundation for the Study of Cycles, especially the reborn version, which I'm finding is really living up to the name and the legacy of the past when it was hot in the 40s through the 70s.
Mm-hmm.
You're doing a great job. Keep it up.
All right. Thanks. Talk again soon.
All right. See you soon.